Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. 18 weeks ago I said here and at every opportunity since, and I quote, "The only thing to bear in mind is not here on this daily chart but in Chicago soybean meal." And that is the well-highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either. End of quote. I feel I must keep repeating this point, that in all things this year and going forward should be seen in the shadow of this pattern. Okay, so from the May double top, we have seen prices head lower at the start of June and thereafter. The primary target 1175 was easily achieved, and the secondary hard to reach target in the 1151 zone was achieved 6 weeks ago. The next feature is one I drew and spoke about 8 weeks ago, and I quote, "I've drawn a new, small, recent, bright red highlighted bearish Andrews pitchfork for the action during May. It is a nascent pitchfork, but I've decided to place it in anticipation of a possible move lower." End of quote. Well, I've not had to do anything to this pattern, not at all, as it worked well until the changeover gap. And I'm still minded to keep it on to show the bearish angle of attack. So hence, we are just below the lower time right now, which is currently at 1030. Interestingly, the changeover gap happened right at the 61.8% absolute Fibonacci line at 1106. I spoke about this 5 weeks ago, and I quote, "Below, we really only have the 61.8% absolute Fibonacci line in a way at 1106 before we test down to November 2020 low at 1045. That is something to ponder upon." End of quote. The move lower was quite swift and has continued to be so even today. We originally had 3 bands of static support plus a dynamic support. The first of the static supports was the previously mentioned 1045 support, then a congestion between 1031 to 1033, which held up prices 2 weeks ago. Then the October 2017 low at 1017. In between these last two is the dynamic support of the late April 2020 to date uptrend, currently at 1028, which is highlighted in dark blue on my daily chart. Of all these, the uptrend looked the most formidable, but only in relative terms, because as I said last week, and I quote, "I would ask you to bear in mind the large overhang we have on top between late January to the start of July, roughly between 1130 to 1243. Right now, along with the other bearish factors that sit on top of this market." End of quote. Well, we have seen this week a penetration of all those levels, and we are on the verge of stabilizing below all of them. If we do, then we seemingly have little in the way below, bar some congestion-based support from September 2020, until the actual September low at 990. And I'm not sure how good even that would be, given the overhead ammunition pressing lower. These actions also have highlighted that the January to May action was a form of a halfway hesitation, with the origin of this bearish halfway hesitation starting back in late November last year. And the potential for a move lower is down in the 980 zone, just below the September 2020 low. Looking even lower, we do start seeing some longer term supports enter the frame in the 895 to 910 zone. I will discuss these more fully should we start approaching. Chicago soybean meal. Back in late February this year, down at 326.90, the market consolidated after a significant fall that developed from the middle of November last year. This congestion was different compared to early ones, as we had crossing through it back then the dark blue highlighted extension to the lower trend line, and that's currently at 324.30 of the July to September 2021 descending triangle. I said 20 weeks ago, and I quote, "This may be nothing, but I'm minded after such a fall as we've seen since last November last year that this may, just may, see some hesitation around the 327 to 325 zone. I'm not certain on it, but it's worth considering." End of quote. Well, prices utilized this dark blue highlighted extension to the descending triangle as a base back then and rallied back up, eventually ending up being capped with a double top formed over May with the help of the declining long moving average, currently 366.40, and the 50% Fibonacci line of the August 2020 to March 22 move at 390 even. The construction of this double top event inevitably led to a move lower, down through the primary target below at 352.40 and the secondary harder to reach target down at 343.30. The key break lower happened at the third attempt at pushing down below the flatlining purple highlighted medium moving average, currently at 348, which one must now regard as a prime resistance for the future. The double top also spawned a new feature, a bright red highlighted May-based bearish Andrews pitchfork, which I drew 8 weeks ago. You may remember I only drew this pitchfork to help in showing the channeling lower of this market, and I was happy to finesse it or retire it as necessary. However, the market has taken on board this bearish pitchfork at least most of the time. We have seen prices push up over the upper time, that's currently at 320.20, in early July and again last week, and this coming after a significant changeover gap between 335.90 to 319.5. Since that gap 2 weeks ago, prices have recovered enough, but it still has left a small fraction of the changeover gap open right now. We could put this recovery upwards down to the effect of the bright red tines below, or the October 2021 low that's still a little lower at 309.30. However, I am minded to look to that original dark blue highlighted extension to the lower trend line of the July to September 2021 descending triangle, which I mentioned earlier, as being, if not the main factor, then a key element in the pullback higher. This now just leaves what will happen next, and for this I would still look lower for a test again of the dark blue trendline extension. Now, there is an argument to say the action since December last year could be a possible large double bottom. However, right now that doesn't sit right with me, and I would suggest further testing of the dark blue trendline and maybe, just maybe, a trip down to the congestion between April and August 2020 between 282 even to 300. The key point for such an idea is something I raised here 57 weeks ago. Yes, a full calendar year ago. And on every occasion, opportunity since, especially back at the close of 2023. It was how the whole of 2023 was an annual key reversal down in Chicago soybean meal last year. This feature, this potential, if you like, hangs over all of this market more than anything right now, and all action should be seen in the shadow of this pattern. Chicago soybean oil. The market's drift of sideways to low this year has been down through 3, possibly 4 bands. These are 44.68 to 45.04, made up of the 2014 high at 45.04 and the May 23 low at 44.68. Then the tight 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line at 43.80 and the April 2014 high at 43.94, with the nearby neckline extension highlighted in bright red of the October 2019 to February 2020 head and shoulders top at 44.38. Then there's the interesting congestion down at about 42.65. Now, I mention all these because some 55 weeks ago and numerous times since I said the following about a big descending wedge pattern that was on my daily chart back then and is now high up off the top of my chart. I said the following, and I quote, "I would consider this descending wedge pattern may have lately morphed into a possible scallop pattern." End of quote. So this was a big pattern idea, and the market's decline since autumn of last year fitted in with this, with the expectations I've voiced of eventually witnessing a fall down to the area of the May and June lows between 48 even to 46 even, which is where we have been until recently. I've often stated here I would keep a very, very close eye on this idea, as any significant breakdown below the 48 to 46 zone could signal the start of the rest of this move lower. I said 20 weeks ago, and I quote, "So far I'm not convinced of the move, that we've seen this break lower already. No, not just yet. However, 3 things to bear in mind. Firstly, this is a really big pattern stretching from November 2022 to date, so do not expect any immediate sharp movements. Secondly, data indicates about 3 out of 4 times the market breaks lower. Just be aware of that. Finally, I would like to float the idea of a recent unusual bear channel." End of quote. Now, the bear channel I mentioned is highlighted in dark blue on my daily chart. It's currently 36.74 up to 44.36, and it started at the beginning of 2024. Mixed in with this bear channel, close to the upper bear channel line, is the green highlighted short medium moving average, currently at 45.12. I'd previously used this moving average as a proxy for the upper bear channel line when I began tracking the pattern before I drew a proper upper bear channel line. Now, we saw earlier the market trying to edge out on the top side of this bear channel, culminating in the late June, early July rally that reached up to the congestion top side at the 38.2% Fibonacci line at 48.95. All these attempts have ultimately been unsuccessful, and we are back down where we have been since late April. This week, for the first significant time, we are not only below the broken dark blue upper bear channel line, but also at the same time below the neckline extension of the bright red October 2019 to February 2020 head and shoulders top. I spoke about these two and their crossover in last week's commentary when I said, and I quote, "These two crossover in the middle of next week," so that is this week now, "and it makes me think that this market may thus be coming to a cusp and choosing which of these two will be the dominant trend line." Now, I'm quite prepared to see prices trail along the top of the broken dark blue bear channel line, yet at the same time I cannot but help notice how powerful has been the bright red neckline in supporting this market, as well as the congestion seen down at 42.65. One way or another, the blue or the red will have to give way. It may not be as early as next week, but it will be soon. End of quote. We have not as yet stabilized below both these trend lines, but it is increasingly looking as if the dark blue upper bear channel line may be becoming the more dominant. If that becomes the case, and we still have not secured this avenue, but if it comes that case, then we have some significant potentials on the downside. We've not secured it yet, but if we do, we have some significant potentials on the downside.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.